It's good to have you here. We're back here once again. We're looking at trade deadlines and the possible impact of tariffs going higher on our biggest trading partner, the EU. Howard Lutnick also mentioning that the administration is looking to renegotiate the USMCA, which is a year away. But does that trade the math on the idea that tariffs may be, I guess, more reasonable, if you will, on Mexico and Canada?
Frank, that's a great question. I think when investors are thinking about, that question, they're looking to see, what's happened before. After Liberation Day, it looks like anybody who was scared off by tariff talks and what's going on in Mexico or Canada or anything like that has shown that they're looking at today with the market up almost 10% for the year. So regardless of what happens with talks in the short term, the U.S. consumer is proving themselves to be very resilient. And you're seeing it from every metrics we're looking at.
Obviously, earnings season continues this week. We have a number of big names. That includes Tesla, also reporting this week. About 20% of the S&P 500 is set to report. How do you see this week shaping up? Do you see a lot of risk in the market right now with a lot of these names that have moved considerably higher since April, just having the possibility of pulling back even if earnings are good, kind of similar to what we saw from Netflix last week? Good earnings, top and bottom line beats, improving their outlook going forward, and the stock's still traded lower.
Yeah, I think that we're going to have a great earnings week. I mean, look at the financials that happened last week with the earnings. No bank surprised to the downside pretty much. And I think you're going to continue to see that going forward for this week. The U.S. consumers are showing themselves to be incredibly strong. And investors, when I'm doing mid-year reviews right now, are kicking themselves if they got out of the market because of any uncertainty with tariff talks or anything else. So investors, I think, are still clamoring for tech stocks. You're going to see a lot of tech companies report this week. And if you see any major tech companies go down to the downside, you're going to have, I think, a lot of investors who have been sitting on the sidelines who've missed this upside over the last 6 months, get in and try to swoop up some of these stocks at lower levels.
By the way, important to note, earnings season is getting off to a better start than expected. We're just showing 6.7%. The estimate going into earnings season was 5.7%. So again, better than expected. I want to talk to you about positioning. I was down at the New York Stock Exchange last week talking to a lot of people that were a bit, I don't know if concerned is the right word, but just kind of noticing like really crowded positioning. And then JP Morgan out with a note today. I'm going to read part of it to you. They're talking about really the high beta positioning that's going on. They say in part, high beta crowding could persist. We believe the 100 percentile crowding based on our quantitative analysis not only presents a risk for this crowded segment, but it's also a red flag for the broader markets, implying there's rising complacency in the short term. They also go on to say this crowding is especially unsustainable as it soared from the 25% percentile to the 100% percentile in just 3 months. Your view on people kind of chasing those, I guess, riskier bets in the markets looking for higher returns?
Yeah, listen, I think over the last 3 years coming out of the pandemic, this tech trade has been crowded. And you're seeing that many of these tech stocks continue to surprise to the upside and set new levels of height. So I would say that, yes, make sure you're diversified. Don't, definitely dollar cost average of these names. And you might want to spread out some of these big gains you've seen over the last 6 months into some of the other sectors that haven't performed as well. But, tech is continuing to rule the day, and I'm not betting against it. And none of my investors are either.
All right, so everybody likes tech. I think if you just buy an index fund, you like tech because it's so tech dominated. Tech is obviously a very popular trade if you're looking for returns or you're looking for safety. What other parts of the market do you like, or what other areas do you see as potentially having like some upside opportunity from this point?
Yeah, I like financials. I mean, if you look at the valuations for my financials coming out of the pandemic, they haven't gone anywhere close to what you've seen from some of the other sectors. Large cap financials, I think, also have some potential upside due to possible deregulation coming out of the executive branch this year. So financials, U.S. financials are, I think, the place to be right now if you want to see outside gains. And remember, they're kind of tariff talk free. U.S. financials don't really get affected by any of this. And so I would be there. And I also like, GLD. We didn't do a lot to curb deficit spending. And we're seeing that the U.S. dollar is continuing to go down. And in that case, GLD works in both scenarios. So those two sectors you want to own and you want to own for the long term.